In this lecture, we're going to be talking about the different valuation methods. Now, there's two main methods to value the price of a stock. There's fundamental analysis and technical analysis. Technical analysis is the study of prices. Prices and volume. So the prices and the quantity that a product has done to predict the future price. Fundamental analysis is when you're evaluating everything else that has to do with the company, meaning their earnings, their dividends, their cash flows, their taxes, geopolitical stability, the industry, new products, anything. Okay. So which one to use and when to use them. Okay. Now, back in the days, you could get away with being somebody who could just do technical analysis and make money. You could also have gotten away with being somebody who only does fundamental analysis and get away with making money. Nowadays, the markets are too competitive for you to not use all the tools you have at your disposal. Back in the days, you might be a very good basketball player because you were good at throwing three-point shots. But you weren't good at anything else, but you were good at three-point shots, so you were great. But nowadays, if you want to be successful as a basketball player, you gotta be good at dribbling, at throwing three-point shots, at dunking, at going in defense. You gotta be well-rounded. So I always tell my traders, if there's something to learn and that you could use to increase, your chances of success, you have to use them. Now, that being said, when would somebody use technical analysis and when would somebody use fundamental analysis? Let me ask you this. Imagine you wanted to buy a house, okay? And your objective is to buy a house, okay? Let's see here. If you want to buy a house, isn't this a nice house? Okay, you want to buy this house. Now, if your objective is to buy this house and keep it for maybe 20 years or maybe 50 years, what are you going to look at? Probably you might look at, I don't know, the material that is used. You might look at, let's say how well it's isolated. Okay, so for winter, so the heating. You might look at the pipes. You might look at the current rent that people pay in that neighborhood. If there's anything new that's going to be constructed around a new highway, a new mall. All of these things, because these things might affect its price in 20 years. Now, if your objective was to buy a house and hold it for 1 week, you just want to flip it, buy it and sell it quickly, what are you going to use? What are you going to use to, evaluate that house? Are you really going to look at the material and the pipes and all of these things? And if there's something that's going to happen 10 years from now? Not really. What you're going to be looking at is other houses in the neighborhoods and how much they're selling for and how many are selling, right? Because all you want to do is buy and sell right away. So if you want to sell in the short term, what matters the most to you is prices and quantity. The thing you care about is other neighboring houses, how much they sell at, and how many have sold. So you can know if there's supply and demand or if there's demand for that house right now. So you can buy it and sell it away right now. If your objective, again, was to hold it for 20 years, you're not going to look at current quantities and purchase and sells because you don't care. You're not going to flip it and sell it in a week. You're going to sell it in 20 years. So you want to know the other things that are going to impact its value within 20 years, right? Because the fact that it has really good pipes might be good because you're holding it 20 years, but the fact that it has really good pipes, you don't really care about that because you're just going to sell it again, right away. Same thing with stocks. If you have a stock, okay, and the stock is trading at $10, and there's a lot of volume, a lot of people are buying it, but your objective is to hold it for 10 years because you think that this industry is going to be doing good because, maybe natural resources are going to be more in demand and electricity is going to be more in demand and oil is not going to be in demand, and whatever studies you've made tells you that this is going to be really good. Well, that's all these fundamental information is good, right? Because it tells you something about the future, right? So you're going to use your fundamentals because it's long term. Just like with the house, you used fundamental data about the house, things that matter about the house. Now, if you planned on buying something and selling it the next day, well, are you really going to look at all these fundamentals down the road? No. You're just going to look at prices and quantity that are trading right now, because that's going to be the better predictor for the price that's going to happen in the next few days, right? The other fundamental reasons aren't going to. Other fundamental reasons require time for them to affect the price, or for them to be correctly priced within the stock. So that being said, and that's why you're going to see that a lot of short-term traders use more technicals and longer-term traders use more fundamentals. Let's say Warren Buffett. Warren Buffett's only uses fundamentals, right? Because he holds things for a long time. He doesn't even look at a chart. He'll just buy it because he knows how much it's worth, and he gives it the time for other participants to realize that, and for the price to correct itself. Now, other traders use just technicals. Us, we're going to use both. Now, we're not going to use fundamentals as an analyst. We're not going to get the statements, and we're going to talk about that in another lectures, but we're not going to use the statements to try and predict the price of the stock. What we're going to do is we're going to see how analysts and other portfolio managers use fundamentals to predict a price for the stock, right? We're going to see how they calculate the price of the stock with the fundamentals. That way, if there's ever a change in the fundamentals, if there's a news that comes out and says, dividends are cut or earnings dropped or whatever, we know how that information is going to affect the analysts and the portfolio managers and their predictions or their evaluation of the stock. So if there's a news and that affects their evaluation, we're going to know by how much it should affect their evaluation, and thus by how much the stock price might change, right? It might go from here to here. Let's say there's a dividend cut, and then all the analysts are going to have a different range for the stock than they had before. So us as traders, as short-term traders or medium-term, doing momentum, doing either day trading or swing trading, holding it a few weeks, a month, we're not going to do this analysis, but we're going to understand it. That way, when there's a change that happens to it, we know how it's going to impact the price. And that's what we're going to call event-based trading. There's an event that happens, a fundamental ratio that changes, and that's going to affect the price, and we're going to capitalize on that and get a position in and out. And you can get in a position in and out, get out within the same day and make a really big, part of the move. So that's what we're going to do. We're going to be using both technical and fundamentals. Now, again, the difference is with technical analysis, you're looking at charts. Fundamental, you're looking at financial statements. Technical, you're looking at shorter term. Fundamental, you're looking at longer term. Traders will mostly look at technicals. Investors will mostly look at fundamentals. Now, critics, and can they exist? Yeah, there's a bunch of critics. Some people only want to use technicals and they swear that fundamentals are useless. Other people who use fundamentals swear that technicals are useless and only fundamental works. I think they're both valuable and they're both valid, and you should be good at both, okay? So obviously, we're going to use both. It's going to be in other lectures. And then in the strategies that we're going to teach you in this course that we use in our office, we actually use both of them, and you'll see how. So that being said, that should do it for that. And I'm going to see you guys, I'm going to see you guys in the next lecture.